The year is 2026, and the global economy is no longer moving as one.
For the first time in years, major central banks are no longer aligned.
At the center of this shift stand two institutions shaping global finance: the Federal Reserve in the United States and the European Central Bank. They are not in conflict.
But they are no longer walking the same path. This is not noise or short-term volatility. This is a structural shift in global policy.
A divergence that will reshape currencies, capital flows, and the balance of global power.
To understand it, we must look beneath the surface of each economy.
Because policy decisions are not random. They are reflections of deeper economic forces.
And in 2026, those forces are pulling in completely different directions. In the United States, the economy has slowed, but it has not broken.
Consumers continue to spend, and demand remains strong across key sectors.
The labor market remains resilient, with steady job creation supporting the system.
This strength creates a challenge.
Look, too late,
Yeah, I'm fine.
because inflation has not fully disappeared. What remains is a deeper, more persistent form of inflation embedded in the economy.
This is not the inflation of supply shocks. This is something far more persistent.
It lives in services, in wages, and in expectations that no longer adjust quickly.
This kind of inflation does not fall easily, and it does not respond to simple policy moves.
Cutting rates too early could allow inflation to rise again beneath the surface.
Waiting too long could eventually slow the economy more than expected. This leaves the Federal Reserve in a position where every decision carries real risk.
If rates are cut too soon, inflation may return before it is fully contained. If rates remain high for too long, economic growth could begin to weaken.
There is no clear path forward, only trade-offs between stability and control. In 2026, the strength of the economy has become the Federal Reserve's constraint.
Across the Atlantic, the situation in Europe is fundamentally different.
The Eurozone economy is not overheating, it is struggling to gain momentum.
Industrial output is slowing, and business confidence remains fragile.
Growth exists, but it is weak and highly vulnerable to external shocks.
And the most critical factor shaping Europe's outlook is energy.
Unlike the United States, Europe remains structurally dependent on imported energy.
When energy prices rise, the impact is immediate and impossible to ignore.
Costs rise across the system, from production to households, without delay.
This is not driven by demand, and this is inflation imported from outside the system. And once it enters, it spreads quickly through every layer of the economy.
This places the European Central Bank in a far more difficult position than the Fed.
Raising rates could push an already fragile economy closer to contraction.
But holding rates risks allowing inflation to spread further through the system.
Every option carries consequences, and none of them offer a clean solution.
In 2026, Europe is not overheating. It is under pressure.
And these are my Mempuis land. At first glance, both central banks appear to be doing the same thing.
They are both holding interest rates, and both are waiting for more data. En er wordt tarten noordwendgestraind.
But the reasons behind those decisions could not be more different. The Federal Reserve responds to the domestic strength within its own economy.
The European Central Bank responds to external shocks it cannot fully control.
This creates a fundamental asymmetry in how each system reacts to pressure. In the United States, the focus remains on jobs, wages, and domestic demand.
In Europe, the focus shifts to energy costs, imports, and currency pressure.
Two systems.
Responding to entirely different forces at the same moment in time. And this is where divergence becomes visible, not in rates, but in behavior.
As these systems diverge, capital begins to respond and reposition across the globe.
Higher rates in the United States attract global capital and strengthen the dollar.
At the same time, the euro faces pressure as capital shifts away from Europe. A weaker euro makes imports more expensive, especially energy, amplifying inflation risks.
This creates a feedback loop that reinforces the very pressure the ECB is trying to control. Financial markets do not wait for confirmation. They move ahead of central banks.
Bond markets are the first to react, adjusting expectations in real time.
Short-term yields rise as markets price in higher rates for longer in the United States.
In Europe, yields become more volatile, reflecting uncertainty rather than strength.
The difference is clear. One market reflects resilience.
The other reflects uncertainty.
Equity markets do not react in the same way. They reflect deeper structural differences.
In the United States, corporate earnings remain supported by strong internal demand.
In Europe, companies face rising costs and shrinking margins under energy pressure.
The divergence is now visible across asset classes,
Not just in interest rates.
What began as a policy difference is now reshaping the entire financial system.
As divergence spreads, liquidity conditions begin to tighten across global markets.
Risk sentiment becomes unstable as investors adjust to a fragmented global outlook.
Markets begin to reprice assets, not gradually, but in sharp and uneven moves.
What was once a synchronized system is now moving in disconnected directions. The world is no longer aligned, and the consequences are already unfolding.
From here, the future depends on how these pressures evolve in the months ahead.
If inflation stabilizes, both central banks may remain cautious and hold their positions.
If energy shocks intensify, Europe may be forced to tighten despite weak growth.
If growth weakens in the United States, the Federal Reserve may eventually move first. In 2026, the future of money is no longer aligned, and that changes everything.